Well, hello. Welcome to the You and Your Pension Retirement webinar. I'm Jennifer Rice and I work for Essex Pension Fund. So today I'm going to be talking to you about retiring from the local government pension scheme, or LGPS. I'm joined today by my colleagues from the retirements team. So we've got Oliver Murray, Melanie Moffat, Daniel Frost and Sarah Dawes, and they're going to be answering your questions in the Q&A feed. So while I take you through the presentation. Now, we do have a lot of people joining us today for this webinar. So please feel free to add your questions to the Q&A if you'd like any clarity or query anything that I've spoken about. But if we do get a lot of questions, we might not be able to get to yours specifically during the session, but we'll do our best to explain everything fully for you. As this is a public setting, I just want to remind you, please don't include any personal information in the Q&A. We're not able to discuss your personal circumstances specifically. If you do want to talk about your pensions in a private setting, please just call or email the pension fund team. We'll get back to you and we'll give you a personalised response. I'm going to put those contact details that in on a pinned post in the Q&A, but I'll also put them up at the end of the session as well. So today we're going to cover quite a lot of information about retirement. So we're going to include how your pension works, when you can retire, and how early retirement reductions work. Within that, we will be touching on the 85-year rule. We'll also be looking at some of the different types of retirement. So not all retirements are the same. We'll go over the options available to you if you have an AVC, and we'll take you through the various steps involved in the whole retirement process. Finally, we're going to look at those death benefits which remain attached to your pension even after you've retired. After the presentation, we'll have a Q&A session. We've received quite a lot of questions in advance, so we'll make sure we answer all of those. So let's get started. How does your LGPS pension work? So this is probably the most important section, because how can you understand your annual benefit statement and plan your retirement if you don't actually know how your pension grows or what your options are going to be when you retire? So the LGPS is a defined benefits pension scheme. This means it's not linked to the contributions that you and your employer pay in, and it's not linked to the stocks and shares. So none of the recent turbulence in stock markets impact on the value of your pension at all. Instead, your pension benefits are calculated using a set formula, and they're based on how much you are paid and how long you've been in the scheme for. Your pension is guaranteed to be paid to you for life, no matter how long that is. And that's not all. Your pension is index linked to the Consumer Price Index, or CPI, so it keeps up with inflation. Pensions are increased every April, and it's usually increased by the previous September's CPI rate. But HM Treasury actually makes this decision, and they don't have to use that month, although so far they always have. We're actually currently waiting for confirmation from them about what this year's pension increase rate will be. When you retire, you'll have the option to exchange part of your pension in order to take some tax-free cash. And your LGPS pension automatically includes life cover for your family. So let's look in a little bit more detail about how your pension is actually calculated. So many of you will know that the LGPS changed from being a final salary pension scheme to a career average revalued earnings, or CARE scheme, in 2014. And this means that we've changed how we calculate your pension benefits. But as it wouldn't be fair to kind of change the rules of the game whilst you're playing, the way your pension is calculated is still governed by the rules that was in place when you built that bit of pension up. So when we come to calculate your pension benefits on retirement, if you were in the LGPS during both the final salary and CARE schemes, this just means we have to calculate each section of your pension separately, and then we add the values together to give you your whole pension amount. So looking at the career average or CARE scheme first, this came into being on the 1st of April 2014, and everybody is in the CARE scheme at the moment. So the way that your pension is calculated in the CARE scheme is actually really simple. Every year, your employer tells us how much you've earned between the 1st of April and the 31st of March. Now, this includes things like your basic salary, any overtime or pensionable bonuses or allowances, but it doesn't include things that you don't pay pension contributions on. So that's things like expenses for mileage or payment in lieu of holiday. So we take that pay figure and we divide it by 49, or 98 if you're in the 50/50 section of the scheme. We add this amount to the pension that you've already built up, and then we revalue the whole pension amount in line with inflation. So looking at the example on screen now, if someone earned a nice round figure like £25,000 a year, we divide that figure by 49. That tells us that they've accrued £510.20 annual pension. So in this example, they've already been in the scheme for a couple of years. They've already built up £2,655.12 a year pension. So we add the £510 to this figure, and then we revalue the whole pension by last year's inflation amount, which was 3.1%. I suspect this year's inflationary increase will be a little bit higher. So this person has built up £3,263.44 pension in the care scheme, and this is being paid out every year from when they retire for the rest of their life. This bit confuses a lot of people when they read their annual benefit statement. The figure is an annual figure, it's not a one-off amount. So when you come to retire, your employer will send us something called your final pay figures so that we can calculate your pension right up to the date that you leave employment. They'll tell us how much you've earned from the 1st of April up until the date that you've left employment. We'll divide that figure by 49 and we add it to the pension you've already built up. But that revaluation part, that doesn't get applied when you leave the scheme. That still happens in April. Moving on to the final salary scheme. The way the final salary pension benefits were calculated actually changed in 2008. And we're going to look at both sections of the final salary scheme. But first, we're going to start with how the pension that you built up between April 2008 and March 2014 it works. So, first thing we need to know is your length of membership in the pension scheme. So, if you are part-time or term time only, your length of membership will be proportioned down to reflect this. Remember, your membership only goes up to the 31st of March 2014, as that's when the final salary scheme closed. Everything you've built up since then is in the care scheme. So once we know how long of membership you've got in the scheme, we need to know your whole time equivalent pay figure. So we actually use a completely different pay figure to calculate your final salary pension benefits from your care benefits. So your whole time equivalent just means that if you were part-time or term time only, this is how much you would have earned if you'd been able to work full-time hours over a full 52-week year. Again, it includes everything that was pensionable under the final salary scheme rules. So this is your basic salary, pensionable bonuses and allowances, and contractual overtime. But the biggest difference is it didn't include any non-contractual overtime. So that doesn't get factored into your final pay figures. When you retire, your whole time equivalent pay figure is usually based on the last 365 days of your employment. So if you have a pay rise sort of midway through your final year, your final pay figure will actually be partly based on your old pay figure and partly based on your new one. We also go back and look at the previous 2-year periods, and we'll automatically use the highest one if you were on higher pay in one of those periods, just so we make sure we give you the maximum amount of pension possible. So once we've got your length of membership in the scheme and your whole time equivalent pay, we just need to multiply this by a rate of accrual. So in this section of the final salary scheme, that was 1/60th. Looking at this example, you can see this person would have accrued £1,894.98 per year pension. But if they'd joined the scheme a little bit earlier, so before April 2008, the final salary pension benefits were calculated in a pretty similar way, but with 2 major differences. So first of all, the rate of accrual is a little bit lower, 1/80th instead of 1/60th. And members also built up a separate tax-free lump sum that accrued at 3/80ths. So basically, in 2008, the rules were changed to make things a bit more flexible for members. So not everybody wants to take a tax-free lump sum when they retire. They'd rather have a bigger pension to live on. So they dropped the automatic tax-free lump sum and instead it's become an option. You can choose to exchange part of your pension in order to take tax-free cash when you retire. They also improved the rate of accrual, so you get more pension for your money. This does trip people up because they see a smaller rate of accrual and they think that means they're getting less, but it's actually the reverse. I find the best way to think of it is that classic cake example. If you have a cake and you need to divide it into a certain number of slices, um, the smaller the number of slices, the better. So if you're cutting that cake into 80 slices, that's pretty thin slices. If that same cake only has to be sliced into 60 slices, you're getting bigger slices. And if you only have to cut your cake into 49 slices, well, bigger slices again. So I hope that kind of makes sense. So you are getting more pension for your money now than you were before 2008. Uh, yep, here we go. So once we've calculated each part of your pension separately, we add them all together to work out your total pension amount. Now, when you retire, you have to take your pension and any lump sum at the same time. You can't take them separately. So you can't take your tax-free lump sum and then defer payment of your pension for a couple more years, I'm afraid. It's all or nothing. But as I said, everyone has the option to take a tax-free lump sum when they retire. So if you were in the scheme before April 2008, you'll have an automatic lump sum which you have to take. But you also have the option, and this applies to everyone, where you can give up part of your pension in order to take some tax-free cash. There are limits on how much tax-free cash you can take. So you can take up to 25% of the capital value of your pension benefits as tax-free cash. So this is not a quarter of your annual pension. The capital value of your pension is kind of a notional value for tax purposes. It's basically, we do this calculation to work out if we had to pay your pension to you in one go instead of paying it to you across your whole life, how much would we have to pay out? Now, I say it's a notional value because we don't actually have term limits. So we pay your pension for life. It doesn't matter how long that is. So the figure we come up with is just a general figure as detailed by how HMRC wants us to calculate that amount. So when you retire, we calculate the capital value of your pension benefits, and then we work out what 25% will be. And when we send you your retirement paperwork, we'll tell you what the maximum amount of tax-free cash you can take is. Now, for every £1 you take off your pension, we're going to add £12 to your tax-free lump sum. So in this example, you can see that this member could permanently reduce their annual pension by £2,350.21 in order to receive an extra £28,202.52 tax-free cash. So they've already got a tax-free lump sum from the pre-2008 membership. So we'll add that together, and that gives them a total tax-free lump sum of just under £36,000. Their pension would then be reduced down from from £7,744.04 down to £5,393.83 a year. Of course, you don't have to take the maximum amount tax-free cash. So we tell you what the maximum you can take is, and you can always tell us, you know what, actually, I want to take a certain amount. So say you wanted to take £10,000 tax-free cash when you retire, you just divide that by 12, and you can see you're going to have to reduce your pension by £833.33. But just remember, your annual pension is permanently reduced in order to convert it over to tax-free cash. Moving on to the most popular question that we hear. When can I retire? So members of the LGPS can retire from age 55 and they must have their pensions paid to them before they reach their 75th birthday. So that's quite a wide range. You can carry on working past age 75 if you really want to, but you can't pay into the pension scheme anymore. So we have to take you out of the pension scheme and start paying your pension to you a couple of days before your 75th birthday. It's worth noting here that there is no such thing as a full pension. That kind of concept sort of went the way as a dodo a couple of decades ago, actually. It's been quite a long time. So instead, you are welcome to stay in the pension scheme and continue contributing and building up more pension right up until just before your 75th birthday, if you like. As long as you are contributing to the scheme, you're going to be building up more pension. So if you've been in the scheme for quite a while, sort of 30, 40 years, you're not in danger of topping out. Your pension keeps growing as long as you are contributing to it. So your normal pension age is now the later of either age 65 or your state pension age. So for most people at the moment, that's either 66 or 67, but this will be creeping up to 68 in the future. Now, your normal pension age is the point at which you can have your pension paid to you without any reductions for early retirement. So if you decide to take your pension benefits earlier than your normal pension age, they'll be reduced for taking it early. And if you leave your pension till later than your normal pension age, they have a very, very, very small enhancement for late retirement. And it's really very tiny. So I think it's about 0.001%. So it's not huge, unfortunately. Now, the UK government gets to decide things like your state pension age and the earliest date that you can access pension benefits. And these regulations apply to all pension schemes unless they've been specifically exempted. We have been informed by the government that they intend to push back the earliest point that you can access your pension from 2028. So in 5 years' time, the earliest you'll be able to access your pension will be 57 instead of 55. Unfortunately, this isn't something the LGPS can overrule. The government gets to make these decisions. We have to adhere to them. But it's something you need to keep in mind. So if you're around 50 and you were thinking about retiring in 5 years' time, I'm afraid you're going to have to hold on for a little bit longer. So if you retire before your normal pension age, your pension is usually reduced for early retirement. So the table here on screen shows how the level of reduction sort of lessen the closer you get to your normal pension age. So if your normal pension age is 67 and you want to take your pension at 60, then you're taking it 7 years early. The reductions shown in the table are split out by a number of whole years, but when we calculate your reductions, it's actually calculated to the day. So if you leave sort of 2.5 years early, the reduction will be somewhere between 9.9% and 14.3%, depending how close you are from one to the other. Now, as I said earlier, when we calculate each element of your pension separately, we do this because it continues to be governed by the rules that were in place when you accrued that pension. One of those rules is your normal pension age. So under the final salary scheme rules, your normal pension age was 65, and it's still 65 for that part of your pension. So it's possible that you can have two different levels of early retirement reductions being applied to different parts of your pension. So here's a quick example. So this person wants to retire at 60. They've been in the scheme in both the care and final salary scheme. So they've got two different normal retirement ages. So we've already calculated each section of their pension and we've added the amounts together. And now we're going to look, now we're going to calculate what those early retirement reductions are. So for their care pension, their normal retirement age is 67. So retiring and taking your pension at 60 is 7 years early. So they got a 29% reduction on that part of their pension. The final salary scheme, their normal pension age was 65. So they're taking it 5 years early. So they're having a reduction of 22.2% against their pension and 11.2% against the tax-free lump sum that they've got. So then after we've reduced it, we add the sums back together to give the total pension and lump sum amounts again. And we can't talk about early retirement reductions without talking about the 85-year rule. Now, the rule wasn't actually on the books for very long. It was just 8.5 years before it was actually removed again. So the protections that still exist have outlasted the actual legislation by quite some way. The 85-year rule can be quite complex, but essentially it said that from age 60, which was the earliest point you could retire back then, if your age plus your length of membership in the pension scheme equaled or exceeded 85, you could retire and take your pension benefits without any early retirement reductions being applied. So if you were 60, your normal pension age was usually 65. But if you'd been in the scheme for 25 years, 60 plus 25 equals 85. You could then retire and take your whole range of pension benefits without any early retirement reductions. So it was a really good perk for people who'd worked in local government for a long time. But they knocked that on the head in 2006. However, people who were in the pension scheme whilst that rule was in place retained some protections based on when they reach age 60 and when they achieve the qualifying level of membership in the scheme. As you might expect, the level of protections has been decreasing steadily as time goes on. So now most people only qualify to have protections applied to part of their pension, and it's usually just the pension lump sum that they've built up until the 31st of March 2008. The protections are applied automatically at age 60, so you don't have to do anything. If you are entitled to these protections, we will apply them to your pension benefits when you come to retire. It's worth noting that because the earliest age you could take your pension when the rule was in place was 60, the 85-year rule doesn't come into effect until 60. So this means that if you are 55 and you have 30 years membership in the scheme, so that equals 85, your pension's still going to be reduced for early retirement. Okay, so you can't get it fully protected just because you've got 85-year rule protections, but it will lessen the amount of early retirement reductions on that part of your pension, because the pension that you've built up, and say that your pension and lump sum that you accrued up until the 31st of March 2008 has 85-year rule protections, and you've already met the qualifying membership, so it will kick in and be available to you without any reductions from age 60. Then 60 is now your your normal retirement age for that part of your pension. So that just means in that case you've got a 5-year reduction if you took it at 55 applied to that part of your pension benefits instead of the usual full 10-year. So I hope that makes sense. It will lessen the amount of early retirement reductions, but it won't actually be completely protected, so you can't take it completely without early retirement reductions at that point. The only way that can happen is if your employer agrees to switch on the 85-year rule early. Got to be honest with you, this pretty much never happens because that triggers a fee for employers to pay. So they have to have a pretty good reason for permitting it. But let's move on to the actual retirement process. So, you've had an estimate, you've thought things through, and you've decided, you know what, I'm ready to retire. How do you actually kick things off? Right, well, the first step might seem obvious, but you have to resign from your job. So you can usually only receive payment of your pension benefits once you've retired from the job that you were contributing to the pension scheme on. So once you've agreed a date of leaving with your manager, they or HR should inform both pensions and payroll. Now, the LGPS is an occupational pension scheme, so the notification has to come from your employer and not you. Ideally, we'd like to be notified in advance of your leaving. Around a month is great for us because that gives us time to send you details of your pension options. So within 15 working days of receiving the notification that you are retiring, we'll generate your retirement paperwork. So this includes an estimate of your pension benefits and all your options for taking a tax-free lump sum. So there are several forms that you'll need to fill in and return to us. So things like your bank details. And then you'll have some time to think about, about your decision. How do you want to take your pension? Do you want to take some tax-free cash? Once you've decided, fill in the forms, send them back to us, along with any documents that we've requested. So we might ask you to send us a photocopy of your passport, or your birth and marriage or civil partnership certificates, just so we can verify your date of birth. And then we'll check everything over that you send us. We'll make sure it's all complete and that we don't need anything else from you. And then we wait. So your employer or payroll department, they'll calculate your final pay figures after you have left employment. So they have to run their final payroll for you before they can generate these figures. And that can take up to a month to produce, depending on when you leave your job and when they run their payroll for you. But we'll check those pay figures. We'll make sure they look correct. We'll query any discrepancies. But assuming everything's okay, we'll calculate your pension and lump sum if you've opted to take a lump sum. And then we'll arrange for payment of your benefits. So if you're taking a lump sum, that's paid by backs. So that sort of takes 7 to 10 working days to reach your account. And then we add you to our pensioner payroll. We'll send you a letter that will confirm the final value of your pension benefits, and this will generally be in line with the estimated value we sent you, although sometimes it's just that little bit higher. Now, then we have to, because we have to close our payroll, so we add you to our pensioner payroll, but we have to close it to new instalments on the in the middle of each month so that we can run our pensioner payroll and get everyone paid. So if you miss the cut-off, you won't get your first monthly pension instalment at the end of the first month after you've retired. It might be one the following month. But if we have to do that, we pay all the arrears due to you in that first payment that you receive from us. Then we'll send you a pay slip so that you know how much to expect, and we'll send that for the first couple. Your second month should be your standard pension amount, so you'll know how much you're going to get every single month. The lump sum, as we've said, is tax-free, but your monthly pension, which is paid on the last working day of each month, that is considered taxable income. So HMRC will tell us your tax code, and we will deduct tax at source. The pension increase is applied every April, and we do send you a letter sort of around March, April time, just to let you know how much your pension is going to increase to once the pensions increase has been implemented. So you see, it should be quite a straightforward process as long as we've got good communication between you, us, and your employer. If your manager doesn't tell us in advance that you're retiring, it's not the end of the world. We'll get notified by payroll when they send us your final pay figures, but of course, that will be after you've left. So it just means it'll take a couple of weeks longer to get you on the system. But it shouldn't be a huge delay, but just a small one, something to keep in mind. Now, there are a few different types of retirement to be aware of, and they don't work exactly the same way. So let's look at some of those. First up, flexible retirement. So when I said you usually have to retire in order to take your pension benefits, the exception is flexible retirement. So this is where you reduce your hours or you move to a less senior role, and your employer tells the pension scheme, okay, bring the pension into payment as well. And it's kind of to help you ease you into retirement. Um, so you get your the flexible retirement is only possible with your employer's consent. They'll have their own policy on it. So they'll tell you how many hours you've got to reduce your work pattern by in order to be eligible. But we bring your pension and your lump sum into payment, and then you'll be automatically re-enrolled into the pension scheme on your new reduced hours role, unless you choose to opt out. So you'll carry on building up a second, smaller pension, and that'll get paid to you when you fully retire. The early retirement reductions will be applied unless your employer chooses to waive them, and that will trigger a financial strain that they have to pay. But if you're between 55 and 60, and you already meet the qualifying criteria for the 85-year rule, then those protections are actually switched on early. I know it's a bit of an oddity. So I know I sort of said employers don't generally agree to it. It's because this also triggers a financial strain. But with flexible retirement, it's not your employer's choice. So if they agree the flexible retirement and you already meet the 85-year rule, it has to be switched on, even if you're not yet 60. Now, moving on to redundancy and efficiency retirement. So if you are age 55 or over and your position is made redundant, your pension benefits must be brought into payment straight away. And we don't apply any reductions for early retirement. So you get all the pension and lump sum you've accrued up to your date of leaving without any reductions being applied. You can't choose to defer payment of your pension benefits in these circumstances. They have to be paid to you, but you do have all the same options for converting part of your pension to tax-free cash, and we just bring it into payment for you. So you have that coming in. Doesn't matter if you then resume work again, that's fine. We just need to bring this pension into payment to you first. Now, lastly, there's ill health retirement. So if you are unable to do your job anymore due to illness or injury, your employer can choose to retire you on ill health grounds. And this can be at any age, because obviously anyone can get sick and anyone can get hurt and find themselves unable to work anymore. You just have to have been in the scheme for at least 2 years to claim a pension from us. So your manager or HR team will make this decision with you, and usually with occupational health as well. Once they've agreed a date of leaving, that's when the pension fund gets involved. So we're not involved in the discussions up to that point. It's once the decision to retire you on these grounds has been made, that's when we step in. So they'll tell us the date that you're leaving employment, and they'll also send us an ill health certificate signed by occupational health, which will tell us which tier of ill health you achieve. So there are three possible tiers based on how likely you are to recover and return to gainful employment. So gainful employment is defined as at least 30 hours a week. Tier one is the most severe. So this means they don't think that you'll ever be able to return to gainful employment, in which case your pension is brought into payment without any early retirement reductions. In fact, it's going to be enhanced. So it's enhanced up to how much you would have accrued if you'd stayed in the scheme up to your normal pension age, but based on your current pay. Your pension is paid for life, no matter how long that is. Tier two is where occupational health doesn't think you're going to recover in the short term, but does think that you will eventually be able to recover and return to gainful employment. Again, your pension is paid to you for life, and it's enhanced up to 25% of what you would have accrued if you'd been able to stay in the scheme up to your normal pension age. And lastly, there's tier three. This one's a little different because this pension is only paid to you temporarily. So this is where you're not currently able to do your job, but they expect you to be able to return to gainful employment within 3 years. So your pension is only paid for a maximum of 3 years. It's paid without any early retirement reductions, but without any enhancements either. Your conditions reviewed by occupational health after 18 months, and your pension can either be continued for another 18 months, or it can be stopped because you've recovered and you've resumed work. Or if your condition has deteriorated, you can be uplifted to a tier two, in which case we'll recalculate your pension benefits and we'll bring it into payment permanently. After 3 years, your pension must, for tier three pensions, after 3 years, the pension must be either stopped or uplifted to a tier two. If it's stopped, your pension will be deferred, so essentially it's frozen, until you reach retirement age when you can start receiving it again. So the judgment about which tier you're on, the decision is based on the balance of probabilities with the understanding of how your medical condition or injury usually progresses. But of course, things don't always go how we think they will. So if you are lucky enough to recover, this won't impact on you if you have a tier one or tier two pension. They're going to remain in payment to you. For tier three pensions, however, if you've recovered and returned to gainful employment within the 3 years of the pension starting, then the pension has to stop. So we're just quickly going to look at some of the options available to you when you retire if you have an AVC. So AVCs, or additional voluntary contributions, are a way of saving more towards your retirement. The extra contributions come out of your pay, but instead of coming over to us here at Essex Pension Fund, they're paid over to one of our in-house AVC providers, so Prudential or Standard Life. They invest the funds for you. And how much you get when you retire depends on how much you've contributed and how well those investments have performed. When you retire, we'll send you lots of information about not only your LGPS pension benefits, but your AVC fund options. So you can usually choose between taking your AVC fund as tax-free cash, topping up your LGPS pension, or buying an annuity with an insurance company, or a mix of these options. Now, there are a few restrictions. As we said earlier, HMRC does set limits on how much tax-free cash you can take from your pension benefits, and your AVC fund is included in those limits. So usually, people can take the whole amount as tax-free cash, but if you can't, we'll tell you how much you can take as tax-free cash, what the maximum is, and then the remaining amount you'll just have to use to either top up your LGPS pension or buy an annuity. Now, if you're thinking, hang on a minute, what about other options I've seen with private pensions, things like flexible drawdown? I'm afraid that's not available for AVCs that are linked to defined benefit pension schemes like the LGPS. The only way you could take up those kind of options would be if you transferred your AVC to a different pension product, so something like a personal pension. But quick word of warning, if you want to transfer your AVC, you have to complete the transfer before you retire from the LGPS. So if you've left your role, even if your pension hasn't actually been brought into payment yet, you can't transfer your AVC anymore. You have to have it paid with your LGPS pension benefits instead. If you're listening with interest about your AVC and you want to know more, don't worry, we're going to do a webinar on buying extra pension later in the year. The last topic we're going to look at today is quite a sensitive one, but it's also a really important one because it's about what is going to be paid out to your loved ones in the event of your death. I imagine most people here are quite familiar with the death in service benefits because we include them in your annual benefit statement each year. But we often hear some confusion about what happens to those death benefits after you've retired. Well, after you pass away, a surviving partner pension is payable to your spouse, civil partner, or cohabiting partner if they meet certain criteria. And this does, of course, include both same-sex and opposite-sex couples. The value of the surviving partner pension will be included in the retirement paperwork that we send you, and it's not impacted by your decision whether or not to convert part of your pension to tax-free cash. Now, we often get asked, well, what happens if I don't leave a spouse or a partner? In that case, your pension simply comes to an end. The surviving partner pension is a proportion of your pension which continues to be paid to you after you've died. It's not an extra fund that can be added to your pension if you're single when you retire, unfortunately. In addition to the surviving partner pension, we also pay pensions to dependent children, excuse me, up to age 18 or age 23 if they remain in full-time education. You don't need to nominate anyone to receive these pensions. We'll contact your next of kin and we'll determine whether there's anyone due to receive a pension from the fund. You also can't transfer these pensions to other people. The recipients are detailed in law and there's no provision for the pension fund to transfer them to another party. So, for instance, if you have separated from your spouse, but you're still legally married because you haven't divorced, they remain the recipient of the surviving partner pension. You can't transfer it to your current partner. So if you've got a cohabiting partner at that point, but you're still legally married to your spouse, the surviving spouse is who gets the pension, unfortunately. In addition to those pensions, there may also be a one-off tax-free lump sum. It's called a death grant. This is calculated differently to how we calculate it in cases of death in service. Once you've retired, death grant is basically calculated as 10 times your annual pension, less any pension that we've already paid to you. So it slowly decreases over time. I say basically because it is slightly more complicated than that if you've converted part of your pension to lump sum, but it is essentially 10 times your annual pension, less any pension already paid to you. The death grant is only paid if you pass away before you reach your 75th birthday. You can nominate anyone to receive the death grant. So family, of course, but you can also nominate friends or even registered charities. You just need to complete an expression of wish form, and you can find this under the resources section of our website, essexpensionfund.co.uk. Or if you've registered for member online, you can update your nomination just by logging in and going to the My Personal Details section, and then just follow those on-screen instructions. Essex Pension Fund has complete discretion over who the death grant is paid to, but we always take your wishes into account. So if the nomination form is out of date or we don't hold an expression of wish form for you, we will decide who to pay the funds to, but we will discuss that with your next of kin. We'll ask them to provide things like your will, if you have one, and things like that will help us make that decision. By far and away, the best option is to keep that nomination up to date, then we know what your wishes are. So that's it for the presentation section, and we've gone through quite a lot today. So you should now have a pretty good idea of how your pension is calculated, about when you can retire and when any early retirement reductions will be applied, what steps are involved in the retirement process, some of the different types of retirement options, what your options will be if you've got an AVC, and what death benefits are payable to your next of kin. So we're going to move on to the Q&A section in just a second, but just wanted to let you all know that the pension fund is always on hand to help you. So you don't have to wait for a webinar or a virtual pension surgery to talk to us about your pension. You can call us or email us using the contact details on screen now. We do have an intermittent issue with our phone where it occasionally doesn't connect to your call. If you do have any trouble reaching us by phone, just send us an email and request a call back. Just make sure you give us your phone number and the best time to call you, and we will definitely get back to you. Uh, the recording of this webinar is going to be added to our YouTube channel, where you can find a couple of other videos that we've done. So you can either go directly to it using the address on page now, on screen now even, or you can just go to youtube.com and search for Essex Pension Fund and it will pop straight up. So you can find loads of information about the LGPS on our website, essexpensionfund.co.uk. That's also where you'll find all of the forms and all of the guides you need. And you can find even more information about the LGPS and lots of really useful tools, videos and calculators on the national LGPS website, which is lgpsmember.org. So I'm going to stop talking and stop sharing my screen now, and I'm going to pass over to my colleagues. Let me just get out of that one. So joining me in County Hall in Chelmsford today, we've got Melanie Moffat, Oliver Murray and Sarah Dawes. So Sarah and our colleague Dan, who's elsewhere, are going to carry on with the Q&A thread, but we're going to answer some questions for you now. So I think first up is Oliver. No, it's Mel, sorry, Mel. So I'm just going to mute my one and we'll go over to Mel.
Hi, everyone. Just a couple of questions that we had in before. One of them was talking about if they've got a pension with a previous employer and one with their current one, would you have to take both pensions or all pensions at the same time if they want to retire? The answer is no, you don't have to take all of your pension at the same time. If you want to go from your current role and keep one deferred, that's absolutely fine. Another question is there an easy way for me to find out how much I will get on retirement from all of my LGPS pensions? Obviously, if all of your LGPS pensions are with Essex, you can contact us. We can get all that information to you. If you have pensions with different LGPS, say Suffolk, Kent, Norfolk, wherever, you would need to contact them individually to get all that information together. Another question was, if I died, would my next of kin have to notify each fund separately? Then the answer would be yes. If they're different funds outside of Essex, they would need to be contacted individually. There is a service called Tell Us Once, which is supposed to do that for you, which tells everyone, not just LGPS, all of your providers, but that's something they would need to look into. And there's another question asking about having a break. So say for this example, it was a period of maternity leave and they didn't buy back their lost pension for that period. How would that affect their pension on retirement? The effect of that would be fairly minimal in the grand scheme of things. It's quite as simple as saying that you put a little bit less into it because of missing that period. So you'll get a little bit less out of it at the end when you come to retire. Obviously, each case is individual, but the impact isn't going to be huge for just a short amount of time. And that's all of my ones. Over to Ollie.
Mel had 4 questions. I've only got 2. My first question was, what happens if you leave local government employment but don't take your pension straight away? Will your pension increase during the years between leaving employment and retiring? Basically, if you leave local government, it's deferred with us, so it's frozen until you choose to take it retire between the ages of 55 and 75, or transfer it out. This will increase each year in line with CPI every April, unless, of course, you transfer it out to another scheme. My second question is, if I retire but then decide to go back to work again in the future, will this impact on my pension? Will I have to notify the pension scheme that I'm working again? The short answer to this is no, you don't have to notify us that you're working again. It has no impact on your pension whatsoever. The only thing I would keep in mind is obviously your pension is taxed, so your tax code may change. But again, we'll get that from HMRC. And that's the questions that I had. I do believe we're going back over to Jen now.
Yep, that's me again. So yes, we had lots and lots of questions emailed in. So we're just going to look. Let me pull up the ones I'm going to cover. So this is a good one. This person likes to know that they work full-time for their employer, but their hours are actually split out over 2 separate contracts. So they want to know how that impacts on their pension. Essentially, it means you've got 2 pensions because the way we calculate your pension is based on how much you're paid and how long you're in the scheme. You have to have separate pensions from each employment that you do, even when they're held under the same employer. Also means that if one role, say, gets made redundant but not the other, you're going to have slightly different options for each pension. So it shouldn't impact too much on like how much you're actually accruing. It just means that you're going to have 2 sets of paperwork to complete when you do come to retire. So the next questions are all about flexible retirements. We're going to look into those in a little bit more detail. The first up was what are the implications of flexible retirement regarding the death benefits? So this is quite an interesting one. So when you flexibly retire, you have your pension benefits brought into payment. So you're technically held as a pensioner on our system. So we've already covered what pension benefits are available after you've retired, how the pensions are paid to your next of kin, and the one-off tax-free death grant that's payable. Now, when you flexibly retire, you automatically get brought back into the scheme on your new job, so your reduced hours job, unless you opt out. Now, if you opt out, it's just the death benefits payable, just as I've described previously. If you pass away whilst you're still paying into the pension scheme on your reduced hours role, it's a little different because then it's technically a death in service and a death on retirement. So how that works is you'll have 2 pensions payable to your next of kin. So that's all fine. So they'll get 2 different pensions payable. So there's just 2 forms to fill in instead of 1. Where the difference lies is with the death grant. So under the LGPS, we only pay one type of death grant. So if you have multiple pensions in the LGPS, so if you've got pensions with other funds or multiple pensions with the Essex Pension Fund, we group them together and we'll pay the one type of pension death grant that gives your next of kin the most money. So if the death in service death grant would be highest, we'll pay that one. So if you do have multiple jobs and you pass away and it's death in service, the death grant is available on both of those pensions. So we'd combine those 2 amounts together. However, if the death grant from the pension that you're already drawing, that you're a pensioner on, would be higher, we'll pay that one. So that would include any other death grants from any other LGPS pensions that you're already in receipt of, and the death grants payable for any pensions that are deferred. So these are pensions that you're not yet drawing, but you're no longer contributing to either. So they're deferred for future payment. So the death grants for those, plus any pensions you're in receipt of, we'll add the death grants together. If that would be higher, that's the amount we pay. So it is a little bit complicated, and we do explain this all to your next of kin, but that's the biggest impact on the death grant rather than the pensions. The pensions will just carry on. So certainly something to think about when you're thinking about staying in the pension scheme on the reduced hours role, or whether you're not too fussed and you want to opt out. So it's a personal choice depending on your circumstances. Does the LGPS set limits on how much you can earn after you flexibly retired? No, we don't. You just have to reduce your hours or move to a less senior role in order to qualify for flexible retirement, and that'll be in line with your employer's policy on the issue. So that one's quite straightforward. Is there a requirement not to work for a month after you flexibly retired? No. So with flexible retirement, your employer will give us a date of leaving, but this is actually a date of leaving the pension scheme, not employment. So it's the date that you reduce your hours. We'll calculate your pension benefits, bring those into payment for you. And as I said, we'll re-enroll you into the pension scheme from the following day, unless you choose to opt out. So you don't need to have a break in service there. It just happens automatically from the very next day. So those are all the questions that we got in advance. I know we had a few others, but I hope I've answered them throughout the presentation. We've only got a few minutes left. Is there anything, team in the county hall? Are there any questions that have popped up in the chat that you think we need to raise now? Okay, so we've got a couple of hands raised.
Oh.
So, oh.
I was going to say, if anyone with their hands raised wants to put some more in, we have had quite a few questions coming in, so we're trying to get them all answered as soon as possible. For example, we've had a couple of questions about ill health retirement. If you would like to give us a call, then we can kind of talk further with you about that, what it would mean. For example, if you dropped your hours, obviously that is quite a personal subject, so we don't want to share that kind of information in the chat, if that's okay. You'll see that I've put our email address and our number pinned at the top of the chat as well. If you missed it in the slide, you can go back, but feel free to contact us if you want any help. Obviously, we would prefer to kind of give you a call, look at your record, can give you kind of further figures on this. As Jen mentioned, obviously we do have some problems with our phone, so if you can't get through to us, drop us an email and we can get back to you, or if you want to send us an email with your number, we can always give you a phone call back and try and go through it with you as much as we can.
I say, added on to what you just said there, we are planning a range of webinars across the year. One of the topics we are intending to cover is actually going to be ill health retirement. So we'll have a specialist webinar on that one, because obviously it can be a little bit complicated, and we wanted to go through it a little bit slower and a bit more thoroughly with you. We'll be able to answer questions there. We'll make that one so that you don't have to register in advance. You can just join anonymously, because obviously not everyone will want their employer to know that they're asking questions about that. So we will be covering that in more depth. We'll be posting those dates on our website once they've been agreed, but we'll also circulate them with all the employers in the fund. So they'll be able to circulate those on notice boards and intranets in your own organisation as well. So just keep your eyes open, and we'll have more information about that soon. So let me just see. I'm just going to click on some of the people who've got their hands raised. Let me just, oh, hang on. So I'm just going to pass the mic over to Carol Page. I think you have a question. Oh, no, sorry, it's, Sorry, that didn't seem to work. I apologise. If you,
No, I didn't have my hand raised. Sorry, I don't know what happened there.
Oh, no problem. Not to worry. I'll look at the next person. So Liz Robinson. So I've just enabling your mic now. Okay, so the mic should be on.
Hello?
Hello? Sorry, can
Can you hear me?
It's working there. Yeah, we can hear you now. Sorry, I don't know what happened there. It was saying, yep, it's working, but then it wasn't.
Okay. My question is, I've got a deferred pension from a previous employer for 22 years, and that was on a higher wage. And that's, I'll say 22 years, and from 1989. And then now I've got 6 years at my current employers, but that's separate to my deferred pension.
Yeah.
So is it better to put those two, is it possible to put those two pensions together? And how do I know if the deferred pension and my current pension is worth more than putting the two together?
Right. Yeah. So this normally happens in the first 12 months of joining, but if your previous pension is a local government pension, so it's also in the LGPS, we can usually still look at that if it's gone a little bit longer. But basically, we can send you details of your options for combining your pensions together, because it depends whether there's a break in service between those two periods.
Yes, there was a break in service.
Was it more than 5 years? Do you know?
I'm
trying to work
not
it out in my
sure. I'd
head
have
from what
I'd
you
have to look
said.
at that, because I went
Yeah.
to a housing association in between, which is probably
Right.
covered, but I didn't include it in anything.
Yeah, no problem. Best thing to do is to email us, because the rules on aggregating and what you'll get out of it can be quite complicated. So what
Okay.
we can do is we'll send you details, and it does lay it out and say, if you combine your pensions, this is what happens to your deferred one. But basically, one of the things you do want to watch, if you're on lower pay and you
Yes, I am
don't,
on lower pay than I was at the deferred pension.
yeah, and if you don't think your pay is going to, go past what you were on when you left your previous role, you might want to be a bit wary about combining those together, because that just means your whole final salary pension could be revalued using that lower pay figure. So
Right.
that would obviously bring it down lower. So if you're on higher pay, you may want to keep those two pensions separate.
Okay, and just to clarify on that, if you want to take early retirement at
Mhm.
55,
Yeah.
do you just have to resign rather than agreeing that you're taking early retirement with your employer? And can they say, no, I don't really understand that bit?
Okay, so for your deferred pension, you can just contact us and say, or whoever's got that
Yeah,
pension with you, you can
it's
just
you.
say, I
Yeah,
want to have that one brought into payment. We'll send you the paperwork.
yeah.
With the one that you're currently paying into, you have to resign from your position. So you can tell your employer that it's a retirement,
Yeah.
or you can just hand in your notice, and we'll
Yeah.
automatically, whenever we get told that someone who's 55 or over has left their role, we'll send out the option to start taking your pension straight away.
Okay.
So it's just a matter of, but unfortunately, you do have to leave that role to have the pension brought into payment, unless they give the okay to a flexible retirement.
Okay, that's fantastic. Thank you.
Okay, no worries. I think we've got time for one more question, so I'm sorry for the other people who are waiting. If you email us, we will answer your questions in full, but I'm just going to go over to Christine Hudson. So I'm just enabling your mic at the moment, Christine, so it should just come up in a second for you that it's been. I mean, so you might have to come off mute. Don't think it's.
Can you hear me now?
I can hear you now.
Okay, thank you. I wonder if you could just put your
Oh, sorry, you've gone quiet again.
question. I just seen it. Oh, have I? Okay. Can you
Oh
hear
no,
me now?
I can hear you again now. Sorry, it cut out for a second there.
Okay. I wonder if you could just put all the phone details and everything to contact you in the chat, because I know one of the ladies said that she'd put it in, but I can't see it in there.
No
So
problem.
that
We'll
would
do
be
it again.
that would be really helpful, because I'm at full retirement age at the moment and I've got a lot of questions to ask.
Oh yeah, if you've got a lot of questions and it's a personal one about your own pension, best
Yeah,
to give us a call or email and we'll go through it. We'll also be doing what's called a virtual pension surgery. I think the end of next month. I'll get the dates posted round as well, and that's where you can book a video appointment with us to go through all your questions as well. But that's like a one-on-one situation, which might be more useful for you.
Absolutely fantastic. But those numbers would be really helpful as well. Thank you.
No worries. Absolutely fine. Okay, so I think we are at past. So what I am just going to do is bring up that last slide again with our contact details so you can all make a note. Let me just find the last slide in the pack. Where'd that go? Do apologise. Yeah, the contact details should be pinned at the very top. But if they're not, let's just see. There we go. Nope, nope, it's come off again. Sorry about that. Doesn't seem to want to work. Okay. So the email address, the best one to know, is pensioninquiries@essex.gov.uk. You can go to our website, essexpensionfund.co.uk, and all our contact details are on there as well. Now, this webinar is going to be it has been recorded, and we're going to post it later this afternoon. So just give me a chance to download it, and then I'm going to upload it to YouTube. Again, just go to the youtube.com and search for Essex Pension Fund. It will pop straight up. So thank you for all your questions today. I hope you found this session useful. Keep your eyes peeled for further topics in the future. We will be sending around a quick survey, just 5 questions, should only take you less than a minute to fill in. And if you don't mind filling it in and completing that for us, that would really help us develop these webinars for the future, so we can make sure we're covering the topics that you want to hear. So thank you for joining us today. If you have any questions, email us, phone us, and we will get back to you ASAP. So thanks very much, everybody. Goodbye.